You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor series, where each week we give you a raw and honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we also attempt to answer your questions. As usual, let me start by saying good morning to you, Jerry, and good afternoon to you, Moritz.
Hello, guys. How are you doing?
Great. Good morning. Good afternoon.
Yeah, doing great. For me, this 13th of October is actually quite a special day because it's the quote-unquote anniversary of my son surviving a sudden cardiac arrest a number of years ago. So it's always a very special day to wake up to. Yeah, an important landmark. But that is not what we're here to talk about right now. We are, of course, here to review some of the events during this week, and then we'll see how that all panned out for the different ways we do trend following among ourselves. And of course, this week was, how should I put it, a little bit of a different week because suddenly we had quite a lot of optimism over here in Europe, pertaining a possible Brexit deal suddenly. I know stateside, Thursday, Friday, talks about at least a phase one trade deal with China. Certainly also lifted some of the more kind of risk-on assets, but also meant that a lot of the risk-off asset classes were, there was a lot of pressure on those, in particular bonds, and I think gold as well. And of course, as we know, that's not always in the direction of the trend and the positions that we as managers have on right now. So I'm sure there was a little bit of pain there. And actually, as of Thursday evening, which is quite interesting because we've had somewhat of a challenging September and early October. And when I look at my own trend barometer that I calculate every day, I saw the lowest reading that I can remember. And this is going back at least 5 years now, as of Thursday night. So really bad environment from an objective point of view in terms of markets that are in some kind of trending behavior. Of course, this is not unusual when we see some kind of transition period for the markets. And as we also know from history, at least, it's usually not a bad time to get interested in these strategies if you're not already invested or if you're looking to add a little bit more. And of course, I couldn't help, as a final little thing, nothing to do with trend following, of course, but I couldn't help notice that things really have changed in the last 8-9 years or so, because actually the Republic of Greece over here in Europe managed to sell some 3-month bills, I think it was this week, at a negative interest rate. And of course, many of you will remember that they needed 3 bailouts from the IMF and the Eurozone around, at least since 2010. But now they're apparently able to sell us negative yielding bills. So markets change. Everything changes over time, but with all of that in mind, Moritz, interesting to hear how your week panned out, so to speak.
Yeah, good summary. My week was down. I don't want to say it's been a bad week because, as we know, being down is part of the process and it's just part of the game. But I think Monday, Tuesday were kind of okay. And then Wednesday, I don't even remember that much, but Thursday and Friday, just the bonds moved the wrong way. They went down, and that caused most of the losses for this week. I lost 3%, and really most of that is from the bonds. I remember the emissions contract, which I'm long since, really a long, long time, is moving lower. Or has been moving lower at the beginning of the week, probably to do with fears of Brexit, and then that got a bit softer, so it came back up. I don't know. It's been kind of like a little bit of a roller coaster this past week, but 3% down. It is what it is.
And I don't know, this is just a guess. You say you don't remember Wednesday, but that had maybe something to do with Oktoberfest in Munich. I don't know.
Oh, that's yesterday's news. Oktoberfest's over, so we're all sober again, and uh, and uh, and show up at work on time, and nobody's sleeping in and hungover. So another year to wait for that. But
Okay, cool.
yeah.
So we probably had a little bit of a worse week than yours, but month to date it's not too bad. But we certainly, because we have been pretty long the fixed income market, so unsurprisingly, it took its toll. Especially Thursday, Friday, as you said, it intensified a bit as the news were starting to spread through the markets. Long gilts, meaning bonds in the UK, were certainly the single biggest losing position we had, given this optimism after the meeting between the UK and Irish prime ministers. So a bit of a rough period last week. Rest of the portfolio, we saw some losses in grains. I think there were also news not only about China and the US, but also maybe I think about Japan buying more grains from the US. So that gave a lift in prices, which is against our positioning right now. And gold didn't seem like a lot of people needed a safe haven towards the end of the week. So that sold off, so that hurt a little bit. And of course, the British pound suddenly found some strength. So that also was a bit of a challenge to our positions. We did see some gains. I mean, softs, coffee, sugar, and equities. I mean, I'm sure Jerry has something to say about that as well. But equities were decent, and we're certainly long for the most part in equities. I think also Mexican peso did okay for us, but that's so certainly a negative week. A bit of a negative start to the month, but as I said, transition period, perhaps maybe just a correction. Maybe we start focusing on the real problems in the economies again, and it'll all return to where it came from, like we saw with the energy after Saudi Arabia. But time will tell. How about you, Jerry? How was your week?
All the same as experienced that you guys experienced, dollar weakness, and that hurt us. Not as much in the bonds, but we don't have those big profits either. And then, of the 35 stocks, some went up and made new highs. So a lot of diversification there.
Yeah, well, diversification certainly is and continues to be super important. All right, well, let's move on and see if there were some interesting articles, interesting topics, anything that kind of the Fin tweet community picked up, liked, or disagreed with. Who knows? I guess to both of you, what did you have most attention or eyeballs on this week?
I think there's a lot of interest in Larry Hite's new book.
Yeah.
So that got a lot of interest from my followers. Let's see if I can find it.
I actually saw a tweet that maybe it was something you liked, or maybe you quoted Moritz from Larry's book. And it's something along the line, and I'm going to butcher it a little bit, but something like along the lines that trend following, there's no magic in trend following, but what it does is magical, or something like that. And I actually thought that was really nicely
That's exactly right.
put.
That's almost spot on. And I just love that quote because, I never thought about it that way. It's kind of like such a short quote, but so good. Like two sentences or not even two sentences, and it's spot on.
Yeah.
So, I mean, like we all know, there isn't too much magic about what it is that we do. It's fairly understandable. You can explain it to people. And but the results is, follow the price, follow the trend, and it's just great. So I just love that quote.
Yeah, plus you can interpret it in many ways, right? You could look at it as a standalone, but you could also think about kind of the magical impact it has on a wider portfolio if you put it in together with stocks and bonds and all of that. I just thought it was just brilliant. So I'm glad you.
So do I. And, also not looking at fundamentals, not really caring about, whether a business is producing a great balance sheet or whether it is in the news and, this and that and the other thing. It's just so great. It's, that's part of the magic that, if you just look at the price, follow its trend, you don't really care about what that business is doing in the inside. It just works. It just works.
Yeah, absolutely.
Yeah, that was one of my favorite. I retweeted that for Moritz, and I just know that I have that book and I have it in electronic form, and I will be reading it. And as I read it, I'll be tweeting great quotes like that. That he just has that ability to, fire me up and help me see things in sometimes a more complex and sometimes more simple light. Yeah.
Keeping it real and keeping it simple. I think that's he's got a great ability to do just that.
So this is from an article that I think he's been doing a lot of interviews about his book. So this was my most favorited tweet all week. Once again, it's pretty normal for us. Hite's approach is the opposite of the ones used by more traditional investors. To others, losing trades quickly become investments, and winning trades get cut short as eager investors scoop up profits. Hite is swimming in the opposite direction. So yeah, that's a concept I like to talk about a lot, which is everyone, including investors, need to take small losses and not let the losses get out of control and not have it switch categories from a good position to an investment that you're willing to hold because it's at a loss and you're too embarrassed to get out of it. And there's nothing more important, part two, of not cutting your profits short. And I know it's really hard to sit through these sell-offs with nice profits and see some of the profit go away, but some of these trends will last 2 or 3 years. And we just don't really know it, except in hindsight, if gold's going to keep going or if the bonds are going to turn around. And so it's where the big money and it takes a strong will to follow these systems, which probably are going to be more longer term because the data and the back test is going to show that, hold on to these things as long as you can, maybe a year or two, and try not to get too uptight about the profits. There was one article that one tweet that someone put out there that Larry talks about a trade and he was making so much money, he just kept making money and people were encouraging him to get out and he just wouldn't get out until he made I think the max profit was 15 million and then he ended up making 12 million. And he makes this quote in there where he says, my broker could not handle all of this. So it wasn't even Larry who was freaking out about these big profits. It was his broker who was getting uptight about it.
Yeah, I mean, when you think about this, and of course he started way back in the 70s, where there weren't a lot of people that he could look to for inspiration in terms of doing these things. It really takes someone real special to have that focus and to be just laser disciplined and to stick with these things. I mean, I think nowadays there's a lot more that's been written. There's a lot more evidence around it, even though there probably are still, a lot of people who would disagree with the premise of the strategy. But back then, I think he mentioned that there were like 5 or 6 of them doing it. Back then, Keith Campbell, Bill Dunn, and a few other people, and so there weren't that much inspiration to look at. And so I think when you take it into that context, what he did and how he laid the foundation of a great career is just incredibly admirable.
I know I talk about the turtle years and the trading, but it was so important to have the backup, the mentors and the people telling you, oh, you're losing money or you're taking a lot of small losses and your big profits are turning into small profits, and to say that's okay, keep going. And no one was telling these guys. They were just picking it up on their own and seemingly doing the right thing and being very vocal about it, and very intense about it and not backing down. So very impressive.
Yeah, and it's interesting you mentioned that, because that's one of the takeaways that I took from our conversation when we had Rich Dennis on a while back, when I think back about sort of key takeaways, and I often get asked about this, and I think about you, Jerry. I think about how often you mention the importance of that mentorship and just being put in that environment from the get go, and how that is probably impossible today to be allowed that kind of training and stewardship anywhere. So
Yeah, and the bottom line was do the right thing, do the trade, follow the system, and losing money while you're following the system is fine, and no one's going to really tell you that these days. Certainly not clients. And then the pressure is so great in all situations that long-term underperformance or no performance or negative performance is it would be tough to find a situation where that would be tolerated. And as long as you're doing the trades and following the system, everything will be great and you'll be celebrated. I mean, who talks like that? No one.
And it's especially if you're trading at a higher level of vol, which I think, Larry Hite has been doing. He's one of the guys that, became wealthy trading his money. So, you need to have a mentor. A mentor, I think, is even more important when you're trading at a level of volatility, as Larry did, that, takes your account down 50% or more. If you're trading at 5 vol, then that is so much easier to stomach, and maybe you can just hang on to the thing for a couple of years and not get too nervous about it. But if you really want to make larger amounts of money, then you will have that risk and those drawdowns, and they will throw you some curveballs, and that's when you need the support and to stay on track.
indeed. What else? More from Larry or more from other sources of inspiration this week, Jerry?
Other sources as well. I think it's good to review some of the things we've talked about before. It was a pretty nice article from Larry Swedroe talking about how the standard timeframes for evaluating performance for investment managers are insufficient to evaluate the skill of a manager with any degree of confidence. 10 years can be nothing more than noise, a random outcome. Funds that have long periods of outperformance can ultimately underperform. The average period of outperformance by the funds that ultimately underperformed was 11 to 12 years. So we've talked about this, and then just a slight twist on it was previously I had read where studies had showed that it was a requirement of underperformance for long periods of time in order to have better performance in the long run. So that is quite a kick in the ass to sort of set your computer up to say, computer, please show me systems that perform great over time, over a 20-year, 30-year period, but have long periods. It seems to be a characteristic and a need. I need a systematic approach that has long periods of underperformance. No one wants to do that, and hopefully it's not something that would continue to be a requirement, but it seems to be so.
Well, we certainly know from people like Warren Buffett that that's certainly been his profile. He can have several years of significant underperformance, but he's still overall done amazingly well. I think the problem today and the mentality today of many investors, and I don't know whether it's just the institutionalization of all things being, all things finance, is that nobody wants any performance that is either too good or too bad. I mean, we just want average. Everything just close to average. Don't be different in any way, shape, or form. And that's a challenge, let alone, obviously, underperformance in order to create outperformance. But I just find that everybody, are scared of being different from the next guy or from the index that they're being measured against. And which again comes back to this point about, we don't really want to take risk anymore. And so how can we expect to make any real returns if we're so risk averse? What are your thoughts, Morris?
Yeah, I agree. Although, I'd love, like you say, I'd love to be the guy with the great returns. I don't want to be average, but, I just know that the pitfalls in designing those systems is potentially catastrophe. So I'm happy with the rough patch, but with the survival for the long run.
Yeah, I think with our approach with the systems and with all the different markets, currencies, commodities, stocks, bonds, long and shorts, I think we'll get back to a situation where we were very consistent over an annual basis, where we almost always made money. And I think our strategy puts us in a higher likelihood where that would be the case. And the ups and downs and the profit gives backs and the drawdowns can be totally forgotten by the time December rolls around, and we're showing somewhat of a positive return. But there doesn't seem to be much of an appetite these days with pretty much zero to negative rates of 20 and 30% returns and the accompanying drawdowns. And with this look-back periods that I have chosen, and I sort of feel I have to trade in order to be profitable, those drawdowns would be fairly significant the more I increase my leverage to achieve a 20 or 30% return. So I don't know a way out of it. Shorter term systems that I used to trade many, many years ago with a lot of leverage, those systems don't work anymore, according to me, my experience. So I don't think I have much of a choice. I mean, we see other friends and traders that we see their performance, and it can get, plus 30 and then next month minus 20 something. So that doesn't seem to be very fun, nor very, I'm not sure how many clients I could get like that in this day and age.
No, I mean, there's that. I mean, there's the whole issue about volatility in the returns. I think that's a very important point, where clearly people don't want that kind of profile at the moment. And maybe that's just, a result of the fact that interest rates are so low, so you don't have to shoot for much in order to outperform the alternative, so to speak, or the traditional. But on the other side, it seems like now there's a lot of focus on, but you have to make money in the month or even the weeks or even the days where equities are down. So you're just putting more and more restrictions on the return profile, and it becomes unrealistic. I mean, yes, you can do things like that, but then you just lose out somewhere else, which is usually the long-term performance. I think we talked about that last week. We did the analysis. So some of these strategies where clearly you could have made money in February of 2018, or you could have made money in Q4 of 2018. Yes, that you can design systems like that, but you lose out on the long term, and I don't know that investors are prepared to do that either. So the wish list for what our systems are meant to do is becoming longer and longer, and I just don't think you can tick all the boxes. You have to just believe and have conviction in the strategy that we represent and acknowledge and explain and make clear that it comes with certain drawbacks, but in the long term, it's very hard to beat.
Well, and the person that can tick all the boxes, probably the closest to that is Jim Simons. He's not open for investments. So there you have it, right? If you're the guy, if you're so clever that you can tick all the boxes, then why share that wisdom and that IP with anybody else? Just trade your own money.
But there's one box he doesn't tick, Moritz, which is the other one that investors want. They don't want to pay for this, right? So he doesn't tick that with his 5 and 46 fee structure. So, I know what you're saying. He's close at ticking all the boxes, but
exactly.
But not that one.
Look, I think, you can design strategies, or you can think about strategies that will do well in periods of stress, like, the February 2018 or the fourth quarter of last year. And those strategies they tend to be long volatility, using options, buying options, paying premium. And they will, if structured well, if done right, they will, offer you that protection during those periods of time. But if the markets are calm, if they're mean reverting, if not much happens, they bleed, right? And you're losing money. Then on the other hand, you can structure the things that on paper seem to work all of the time, but you put a lot of risk, like tons of risk, into parts of the distribution where it's difficult to see that risk or to know whether it's there. And the result may be ruin. And then there's our strategies, which, depending on how we're positioned, they may be doing well, but, they are rough and, episodic in their returns, but they are, in like everything that I've looked at, the most robust thing that I've ever come across. and I'm willing to trade that for the rough patch and the episodic return stream that comes with it.
Another legendary trend follower that doesn't get much press, but probably should. But I think that's just a function of the size of his program, and that's a guy I interviewed a few years ago called Bill Dries, who I think started in 1976, so he's been around for quite a while. And he was talking also about this point that you can divide or you can develop these strategies where essentially you're warehousing risk, right? You're picking up small pennies in front of a steam train. One day it's gonna catch you, and you're gonna be decimated to some extent. And he talked about trend followers as kind of the opposite, where he's basically saying, I'm taking on the risk and I'm doing that on an ongoing basis. I'm realizing the risk, and we're recognizing it every day with our mark to market, bookkeeping. So it's just a complete opposite than what many investors are looking for, but it certainly doesn't make it less important.
Wayne talks about that in his Twitter account quite often, that you're just, it's really not returns that you're getting because you're going to have to pay them out at a later date. So, that's quite problematic.
It's a good way to look at it. Yeah, I mean, it's a good narrative. If someone wants to listen, I think it's a good way of explaining the difference, right? Everybody loved long-term capital until they didn't. And there are many examples of this. And okay, we haven't had many of them, but the small things. And this is obviously not meant to be any form of warning. But the other thing I picked up this week in the news flow was something like the largest hedge fund in South Korea. Suddenly they have stopped paying out investor money. I mean, it made me think back of the Bear Stearns warning sign before the crisis even began. Suddenly you see places of illiquidity and places of unusual behavior in strategies that may have looked incredibly safe up until that point. Even though I have no idea what they do in this particular hedge fund in South Korea, but
I think it's perfectly fine to give out a warning. And I wish I would have, the CTAs and myself were giving out a warning at the end of 2007, because you should always have a warning that if you're not diversified, if you're not trading with stop losses, keeping your losses small and trading with the trend, and being incredibly diversified, not just long stocks, then your portfolio needs a warning on it. It needs to have that warning sticker all the time. And so we should not hesitate to, even though it gets kind of old. And I was going to say about the previous conversation you guys were having is that, Moritz is willing to stick with this type of approach that has these ups and downs. And what's the competition? It's so low. It's worse. It's way worse. It's an 8% return with over a 50% drawdown. And we're agonizing over, I'm just going to suck it up and do it. So much better than the alternative, or what most people would see as the alternative, or the core holdings that we all have to sort of see if we can fit in. It's so ridiculous. What we do is way better, way safer, and we kind of leverage it up a little bit, and it has some volatility, maybe more than the stocks, and it has worse returns than the stocks. So to the outsider's eye, it's worse. It doesn't even make money, not nearly like the S&P does, and then it's more volatile. So we get in this bind, and we get critiqued by those who don't know any better, who are stock-centric, more of a religious experience than a mathematical experience.
do you think deep down, and this I guess goes to both of you, I mean, do you think deep down, so we know that equities can have, and probably has on average, much bigger drawdowns than trend followers. So do you think deep down that the challenge investors have with the strategy is just the profile, the noise or the volatility on an ongoing basis, the fact that it's less stable? Because it's much more that it is not. I'll try that again. It is not more risky. There's no evidence of it being more risky, but it is more noisy, and it is, it's less stable, if that's even something that can be described to a market profile.
Well, I'd say it's even more stable. So when I look at a very long-term track record of a CTA and I compare that to the S&P 500, then I can only see that it's a more stable return profile over time, right? It doesn't have the 2008 crash. It doesn't have the Euro crisis in there. I mean, it is a more stable thing. And this may just be my personal opinion, but my hunch is that investors don't like the fact that when we present to them that what we're doing is a trend following system and that all we're doing essentially is follow trends, and by the way, it's so simple, they hate the fact that we don't have an opinion on things and that we cannot be sitting there and having an opinion on a company or a macroeconomic environment, or whether Trump is going to be doing this, that, or the other thing, or whether Brexit is going to happen or not, that we're just so boring and we're sitting in the meeting room with them and telling them, I don't know what's going to happen tomorrow, next month, any of that type of stuff. I'm just there following trends. And I believe that they simply hate it and they think we're kind of like nuts and not smart and not clever. And so they go to another fund who has a better story than we do. But if you're really objective and you look at just the track records of CTAs like Dunn, like Chesapeake, for all those years, I mean, you got to be kidding me. This is so much more stable than any of the other investments. And if you just look at that, you want to say, well, you want to scream, I want to invest. And it doesn't matter whether you want to invest, at the low of that track record, just invest now. It's, it's the best indication that you have is to, invest now and for the track record to continue in pretty much the same fashion it has continued in the past with its ups and downs. And of course, every once in a while, you need a very tough stomach lining, or you need to be thick-skinned. I mean, you've just mentioned Bill Dries, and, I know a thing or two about his firm. And, while you guys spoke, I looked up his returns, and he lost this is public information, so people can look it up. He lost 10% in 2017, then he lost another 10 in 2018. Then the start to this year has been down, and then boof, close to 30% up in August, 14% down in September, but still year to date he's up close to 35%. So he's making new highs. And when you look at his track record, which is also a very long track record, right? It's volatile, but look, he's just made a new high. And when I compare this track record to the S&P, this is damn robust. Yes, it's up and down, but this thing is making a new high. And I don't think there's any reason to believe that he'll stop making new highs. Probably just, go on like this. You just have to, come on the ride and ride the bucking bronco. So there you go.
I mean, I'm sure Jerry has some comments on this as well, but the only thing I would change in what you just said, Moritz, because obviously I agree, is that I wouldn't describe it as stable returns, but I would say it's consistent. Our return profile is consistent. It's really always been like this, unlike many other asset classes where it looks stable, suddenly it's not, and therefore it's not consistent. But I think that's a great point.
One thing that I also, because we spoke and we've mentioned Larry Hite, and he's been on a couple of podcasts this past week and the week before. Great guy. And one analogy that he came up with is, if you're offered a ride on a rocket ship, you have to get on the rocket. And, I think this is so true. This is what we're doing with every single trade. It's kind of like our option, our chance to get on the ride, to get on the rocket. We don't know where it's going. It may be a failure. It may take us to the moon, but we have to take the rocket. And if you're given the opportunity, you have to do it. And the beauty about our systems is that, we get so many opportunities. There's an opportunity to go on a short rocket, on a long rocket, on a rocket in bonds, on a rocket in equities, on so many different things. Most of them will fail, but some of them will take us to the moon. And it's, it sounds so strange. And I think this is one of the things that investors don't like about that thing is, it's so simple and the story is kind of like missing about some fundamental thing. But That's what we're doing. We're taking one rocket after the other in the same way, expecting the same thing. It sounds weird. It is what it is.
What are your thoughts, Jerry?
Oh, yeah, that was really good. I think I can remember my thoughts. One was I was just going to sort of tackle you like Moritz did and say it's not so much that our performance is not as good or not as stable or not as consistent as it hasn't been recently, but it is in the long term much, much better. And I think back to not having a story and being so passionate about what we do. And so I think, I have to sort of call myself out because I've called this passive indexing sort of a religion. And I think once I start talking about trend following, sometimes it gets very religious sounding, that no amount of evidence will sway me, short-term evidence. And I'll just keep extending what I say is short-term if necessary. I'm not going to back down. I'm going to advocate this. And we just get in front of people and we think it sounds so great. Yeah, and I think they're like, it just doesn't, hit me like it's hitting you. And so I think it's great to be passionate, but it's just rare people who are going to want to embrace the ups and downs, the math. I think the math turns a lot of people off as well. Can you just please talk about a story and about a company or a macro environment and politics or something versus expectation and drawdowns and following a systematic approach based on a large sample size. So this is just not, we think it sounds great in our head, but when it comes out, obviously I don't think it does.
And the ironic thing is that I don't think our industry really is short of stories. I mean, we have real stories based on real experiments, based on, with real performance to back them up. A lot of the stories that we're saying that we're missing are people coming on to the news media talking about things that they think might happen in the future based on, some kind of subjective analysis, really. So, but people want to be, I guess, deceived in some ways and want to believe this kind of narrative and predictions, and the fact that we, in a sense, are just being very transparent and being very honest, saying we have no idea what's going to happen. We can't predict what the returns are going to be and where they're going to come from. Of course, maybe it doesn't sound very convincing or compelling for that matter. Go ahead, Jerry.
Well, I was just going to say that human nature being what it is, they'll flock to us the next time there's a problem with the equities, like in 2008. But that's just the way human nature is. They will all of a sudden get religion and understand trend following exactly what it is and the benefits of it if the performance is different. So there's a lot of performance chasing and things like that. But let's go to Wayne. He had a good tweet, and I had a follow-up that I was disappointed didn't get a lot more love. So what you guys think? Wayne goes, what really is a fat tail? Textbooks, academic papers offer a fairly wide range of definitions with varying levels of mathematical rigor. Funny thing is, it's all just a complicated way of saying we have no effing idea what can happen. I like that. Bad things can happen. And we need to let people know that we're concerned with those bad things and that we do more than most to try to mitigate bad things with our systems and our rules and our diversification. So then I go on to say, what are the best ways, techniques, processes to protect your investment from the fat tails that will do harm? And what are the ways to try to take advantage of the fat tails that can create mega profits? And I put in parentheses, as if I didn't know. So I didn't get a lot of loves on that. It's what we do. It's trend following. And but oh well.
It's kind of funny when you talked about it right there. I thought going back to this issue about what our industry has as a narrative problem is that, I mean, we choose to talk about fat tails. Other people talk about, how many iPhones can Apple sell next quarter, right? I mean, I know which one I would go for as well if I didn't know better.
Jerry, I just gave you love on that one. I overlooked it, so you have one more like. um, well, I just agree. I mean, we have no F-bomb word idea what's going to happen tomorrow. And, well, of course, statistically speaking, that shows up in the distribution as fat tails. But I agree with Wayne. There's no point speaking about this black swan or that black swan or what could happen then. We just don't know. And, it took me probably at the beginning some time to understand that. And now I'm completely at peace with that, of not knowing.
Knowing what you don't know.
Yep, very important.
Which is what Larry Hite told Alex Grazeman when he was interviewing, waiting for some kind of really insightful answer about why he should join his firm, and then there he goes, knowing what you don't know, and he was kind of quite disappointed, I think, at the time. At least that's what he told me some years back.
Good stuff.
Good stuff. More good stuff from you, Jerry?
Let's do one more with Wayne. We're on a theme here about risk and how dangerous the world is, regardless of recent performance. But he goes on to say, Peter Bernstein said, you cannot manage outcomes, you can only manage risk. In other words, we can't imagine what could lead to a big loss and how big a loss it might actually be. But if we just have a simple rule, such as a stop loss at 5% down, then those questions don't matter. Well, I think it's we can do even more than that. Obviously, keeping the losses small, not overtrading with too much leverage, not overtrading the sectors or markets, and being truly as diversified as possible. Having some shorts on. I'm always big on these shorts. Longs and shorts at the same time. Mitigate risk in a trend following, systematic trading without any sacrifice to profits. I think that is left out sometimes, but all of the things we try to do, it's difficult when you put together a trend following system and a program. It's really difficult to sort of figure out where the profit making starts and stops, and the risk control and risk management. It's just all intertwined together. We're doing both at the same time all the time, and one of the most important things is to follow the prices. And it's totally erroneous to believe that any one market or sector is superior or better trender or anything like that.
Yeah, I mean, that kind of reminds me of another of my previous conversations. It kind of ties in a little bit. A lot of people think about sort of asset allocation as a separate topic within investments and strategies and all of that. And of course, I guess someone like a Ray Dalio, I think, puts a lot of emphasis from his success onto the overall asset allocation, et cetera, et cetera. But then I was re-listening actually to, I had a long drive a couple of days ago, and I was re-listening to my conversation with the founders of AHL, so Adam Harding and Lurik, and we talked about asset allocation, and of course what they were saying is that, well, asset allocation is built into what we do. That it's not a separate issue. It's built into how our models, how our systems work. We allocate according to the opportunities, and so I think that's another thing that's important to realize, that you have that benefit as well. We often talk about just buys and sells and exits and et cetera, but I mean, being so diversified as the three of us are, I mean, the whole asset allocation is built into our portfolios, which is incredibly powerful.
That's the thing, and it's so important. Let me give an example. I think when we had this attack on this refinery in Saudi Arabia, that oil refinery or oil production facility, not a refinery, or maybe also refinery, but some production facility, and we had crude oil, doing the largest gap, I think, in the history of the futures market, right? If you're short that market at that point in time, and you have a stop on, that stop is, you don't get filled at that stop level. You get filled at where the market's going to open, right? So you can have a larger loss than what you think you should have had based on your stop. And it shows again that it's so important, like Jerry was saying, we have longs and shorts on in so many different markets that even though this may happen, and this may happen also in other markets, it's not going to kill you, right? It's not going to, destroy your system. And like, coming back to Larry, I think his rule number one, I haven't read his book yet. I'm looking forward to receiving it. But I think he says rule number one is cut your losers short and stay in the game. Of course, if you can keep the losers small as well, that's even more important. But this is, I think, the true rule number one is to, manage your risk in that way that you always get out of your losers and put the money back into the winners and into the other rockets.
Yeah. Good stuff. We have a couple of questions or topics we can talk about today. The first one, and I appreciate because I think we took a question last week from this gentleman, and I was not sure how to pronounce his name, so I appreciate you helping me out this week by in your question also saying that I can pronounce your name Gaetano, so I will do that. Thanks very much for that, Gaetano. And you have a follow-up question, and that is, since volatility is not only a measure of uncertainty, but also an investment asset like the VIX futures, is it reasonable to apply a trend-following strategy on it? Would love to hear your views on that, Moritz. I don't even know if you trade the VIX, but is the VIX something you can trade as a trend follower in your experience?
I don't trade the VIX in my trend following system. I'm not sure about volatility being uncertainty. I think about a week or two ago, Mark Ryszewski had a great article on this, or a blog article on LinkedIn, on the differences between vol and uncertainty. Maybe worth reading that one. But no, I do not trade the VIX from a trend following perspective because that market volatility is mean reverting. Some may say by definition that, periods of higher volatility are followed by periods of lower volatility, and that volatility has a natural bound at zero and it cannot go to infinity. So it will kind of like oscillate between, kind of like those boundaries. I'm not sure if this is by definition true, but, statistically, the market is mean reverting. That is what I can observe when I look at the market and volatility in and by itself. So I don't think it's a market that's really great for a trend following system. And some people may want to trade a mean reversion system on it. Some people may, trade a short only system on it. All of that stuff exists. I don't do it. I'm intrigued by the market, but I'm not trading it in a trend following style.
Any thoughts, Jerry?
No, I agree with all of that. I've looked at it, the discount between the future VIX and the cash VIX, probably something there. I think maybe trading the VIX is not the same to everyone as trading volatility. I'll throw that out. I don't really know, but maybe there's other ways that are better or more trend following friendly. I think focusing on the VIX, which I have people focus on it for me sometimes, clients, when are you going to integrate VIX into your trading, is once again to be kind of like avoided in a sense that it seems to be more stock-centric. The world revolves around stocks. It's the only thing out there worth paying attention to the degree that you fit in and you can help me with my stocks, then that's how I'll deem your worthiness and how you offer value on this planet, which I reject all of those ideas. So I think the best crisis alpha and the best way people could help their stocks is not worrying about VIX or trading VIX, but letting the trend follower trade your stocks with the trend following. The 80% of your portfolio that you have in stocks, you should use trend following for that. And if you really want to help with some sort of crisis.
Yeah, and I concur with all of that being said. I actually don't think you really can unless you were super short term. Maybe you could devise something to, but I wouldn't even call it trend following. We do have on our side some experience with the VIX, but not in a trend-following fashion. It's an area of interest to us, for sure, and we've been, having a small allocation to the VIX for the last 3.5 years or so, but again, not as a trend-following approach. Yeah, so I hope that gives you some answers. And then finally, just a topic that we could talk about. It comes up from time to time, but since we don't have any other questions today, specifically, maybe sort of this whole debate about whether trend followers can make money in rising interest rate environments. Obviously, we're hovering around very low levels of interest rates. At some point, I guess it's safe to say we're going to have a rising interest rate environment. We just don't know when that's going to happen, but it will. And so the question is, since most trend following live track records, with very few exceptions, has been, in the last 30 years or so, 35 even, and therefore they have enjoyed the kind of the benefit that the falling interest rates have had in terms of bonds and their kind of rise in price. And since it's a big, there are a lot of bond markets you can trade. Of course, the criticism of trend following is often that it relies too heavily on returns from fixed income. So, I can say from our side, we actually traded back in the 70s, and therefore we did trade through, I think it was 76 through 81 in particular, where interest rates rose a lot. And if I go back and look at our track record back then, it was an incredibly profitable time for Dun. That's not to say that the things would happen in the same way. We don't know about future returns, of course. Let me put that in, but at least there's some real returns, that we can point at least. But what are your thoughts? Do you come across this debate as well, or what are your thoughts about trend followers relying too much on interest rates as a source of return? Is it something we should even be discussing?
Well, first up, I don't think I'm relying too much on interest rates for my returns. I give interest rates the same opportunity in the portfolio as other markets.
But do you have more markets, though, from that fixed income sector relative to other sectors? I guess that's what I meant, if I didn't make that clear.
There may be more markets, but I do, make adjustments for correlation.
Okay.
As we have said before.
Okay.
So if I'm trading the Bobble and the Bund, then I know those, two markets tend to move in tandem. So, I kind of put them in the same bucket. So
Sure.
I really want to say that in my portfolio, very objectively looked at, interest rates or fixed income markets do not have the front row seat compared to any of the other markets. I really try to give them the same opportunity to add volatility and risk and P&L to the system as any other market. There's no preferential treatment there. Now, I'm lucky to say I'm too young. I've never traded into a rising interest rate environment. So the only thing I can say is when I backtest my system, I can look at how did it perform based on today's rules and based on the parameters that I'm using today. How would that have performed, for instance, in the 80s, right, or other periods of rising interest rates and higher inflation? And it has worked. It may not have worked as well, but it has worked. So I cannot say that I'd be afraid of a rising interest rate environment. And maybe because we're then short that market, there's a little less carry that we'll make from the market, but it also depends on, is that carry going to be there? I mean, which shape does the yield curve have at that point in time? None of us knows that. And then also, I think some people tend to overcomplicate the matter. I mean, the price of the forward rate is baked into the futures contract already. It's already in that price. So if interest rates are rising, I'll just short the bonds and try to follow that trend. So I don't want to overcomplicate those type of things. I'll be equally fine trading it on the short side as I am trading it on the long side. maybe our judgment is clouded by the fact that trading it from the long side for so many years now has produced spectacular results.
Yeah, I mean, I'd love to hear your opinion, Jerry, but I will say that I've certainly heard this argument in the last few years from some of the not necessarily the usual short-term managers, but there was definitely some short-term managers a few years back when the first time the interest rates in the U.S. Came to these levels, and made a big splash about this and so on and so forth, and that didn't hold true. But I agree with you, Moritz. I mean, there's no evidence, as far as I can tell, that trend following strategies won't be equally profitable during an interest rate rising environment. So, what are your thoughts, Jerry?
Well, I do think it's problematic to have a large bond position and in a large energy position or a large grain position without regard to it might be more or less one or two trades there. And and so I do think not overtrading in general, not overtrading the sectors or those sectors I just mentioned is something that CTA should not do. I think I agree with it if that's part of it. I hear this a lot, but I don't hear a lot of specific complaints exactly what they're talking about. And because I was sort of thinking something else when you originally asked the question. But I do think those are issues. Take advantage of if you trade the bonds too large, if you trade the stocks too large or energy too large, crude, heating oil, unleaded, Brent, gas oil, all of those, as if then you overwhelm the other markets that are uniquely not correlated to anything. Palladium, cotton, coffee, cocoa, sugar, cattle, hogs, emissions, oil, bean oil, canola, et cetera, et cetera. So there is a Bitcoin. So you've destroyed all of that diversification. You've minimized the benefits of all those other markets by saying, I got on 8 grain positions or 14 bond positions. It doesn't make sense. And I think that is a problem. I know I did it. I might still be guilty of doing it a little bit. But on another subject, I would say that guilty is charged, if I could just restate it, which is that CTAs make all this money when one group of markets or one sector goes up a lot. Yeah, of course. That's what we do. We play for those outlier, that fat tail. So we should be making a ton of money on the sectors and the markets that are the best trending markets. We should have made more money in stocks probably, get away from those indices and trade the individual names. But certainly in the bonds, they've done well. It's been a bull market for many, many years, and we crushed it. And because we trade all of the other markets in relatively equal proportions, and we use trend following systems on those as well, if markets that haven't done well the past 20 or 30 years start doing really well, having big trends up or down, those markets are going to dominate our performance as well. And so that is the nature of what we do when there's crazy moves that nobody could predict and they go a long, long ways over multiple years. Yeah, it's going to dominate our performance. Guilty. But that's the way you make money in the markets.
I think that's a great point, actually, and I think it was someone like maybe John Templeton or someone like that who once said that in order to make superior returns you have to have conviction, and I think that's exactly what you talk about there, Jerry. That yes, I mean our systems build up this conviction from the signal strength, and if that signal strength just happens to be in one sector, well then that's perfectly fine. I mean, we'll go with it until there's no conviction in that sector anymore, and there's nothing wrong with that. And we'll shift our asset allocation to the next sector that shows conviction, and that is that. Yet a lot of people want to criticize the fact that we dare have conviction. We don't want to be average. We don't want to spread our risk so thin that we can never make money above some kind of risk-free rate of return. So, yeah, I think that's a great way of describing it.
Yeah, it reminds me of a little bit of what's going on in American baseball. And it's just a crazy change over the past few years where there are more home runs hit, than ever, and more strikeouts. So this philosophy of not, your average trade being dominated by big, huge moves is it's uncomfortable for people. Why can't we just like score a couple of runs every inning and be more consistent and more even and flow? Why does it have to be these shocks and these small losses on a monthly basis? Then all of a sudden you make tons of money or you score lots of runs, and it just doesn't sit as well with us. We want to be told life can be corralled and be more calm, and I'll show you how to have less stress. And the markets are like, nope. If you want to make money, maximum stress.
And of course, we shouldn't forget that when you talk about equities, it's perfectly fine that all the returns in the S&P came from 7 stocks or the FANG stocks or whatever. That's not a problem. That that they were the return drivers, right? So if you didn't have them, you didn't make any money. But as soon as it's something like, CTA is making a lot of money from bonds this year, that's the problem. Don't like that.
Great point.
Because it may not happen again. You can't rely upon it.
No, that's right.
And what we're saying is, we don't even know when we do our analysis. We cover up the name of the market. It's the bonds today. It'll be commodities the next time, or stocks, or short stocks. And we're just going to do the same approach with all the markets, just following these trends. And we really look at it as we appreciate the diversification, and we understand it, and we try to create the portfolios, taking correlation and diversification into account. But where the profits come from, we're totally agnostic. We have no prediction. We don't care. We're just going to follow those trends and be as surprised as everyone else.
Yep. Good stuff, as usual. Thanks so much for sharing those thoughts. Maybe while you, as usual, think about anything else to bring up, I just want to run through performance through Thursday. I do believe Friday was a bit of a rough day, maybe in the trend following space. Not too bad, but it certainly wasn't a positive day, so just bear that in mind. But beta 50 as of Thursday night, down 1.36 for October, up 7.71 for the year. SocGen CT Index down 1.29 for the month, up 7.2 for the year. SocGen Trend Index down 1.79 for the month, up 11.6 for the year. And the SocGen Short-Term Traders Index down 0.33%, up 1.48. And the Flat Fee Index, Bridge Alternatives, did not have an update for me as of Thursday night, so I don't want to quote any older data. But, in line with our own expectation, as we talked about in the beginning of the episode, that it's been a little bit of a down start to the month of October and the fourth quarter, even though I think anecdotally at least the fourth quarter sometimes turns out to be quite spectacular in some years at least, so there's still plenty of time. Anything else that you want to bring up as we bring it to a close, so to speak?
Just like Jerry said, we'll be surprised again. We don't even know what's going to surprise us. There's lots of things probably, with Brexit in the next 2 or 3 weeks, and, trade war still going on. So all of those surprises will be thrown at us, and we'll just take them as it comes. And I wish everyone a good week ahead in the markets.
Yes. Trend follow every second, minute, hour of the day. I'm always looking to buy higher prices. Buy high, sell higher.
Mm-hmm.
Exactly.
And even though if we don't know if Brexit will happen on the 31st of October this year, we do know that our live event will take place on the 26th and 27th of October in New York, in Manhattan. I think there's one spot left if anyone wants to meet up with us. And not only us, actually. We also have our special guest now, Denise Shull, famous trading coach, to talk about the mental game and help us all understand that better. So if you're interested, let us know before we close the event for new attendees. So with all of that in mind, thanks for listening to this episode of The Systematic Investor. As always, you can find notes and links and other episodes on toptradersunplugged.com. From Jerry, Moritz, and me, thanks so much for listening. And until next time, have a wonderful and profitable week ahead.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of this.